Welcome back. Today we're looking at a high-energy analysis of BigBear.ai, focusing on the Ask Sage acquisition and that big Q3 earnings beat.
Right, and the piece gets straight to the point. It correctly identifies the two main catalysts, the $250 million deal and the Q3 double beat. And it does a good job laying out the P numbers, like the projected ARR and the cash on hand.
It does. It really sets the stage for a major turning point. But as we dig into the financials, I think there's an opportunity here to really strengthen the argument, especially for the kind of, detail-oriented reader this is aimed at.
I agree completely. Let's start with the Q3 results.
Okay, the material highlights the key metrics pretty well, especially that surprising $2.5 million positive net income. It frames it as a sign of good balance sheet management.
And that's a solid foundation. But I wonder if we're maximizing credibility with that point. The discussion of the surprise profit needs a more integrated approach to disclosure to really fortify the argument's credibility.
I see what you're getting at. It's a structural issue. So the weakness is that the document notes the profit was mostly from non-operating items, things like fair value adjustments. But it's tucked away in a parenthetical note. It feels like an afterthought.
Exactly. And for a skeptical reader looking at a high-growth AI company, that immediately raises a red flag. It feels like you're trying to downplay a crucial detail.
Or hide it, yeah.
So the suggestion is simple. Integrate the source of that profit directly into the main analysis. Don't treat it like a footnote. This shows a higher level of rigor, and you can still drive the same bullish conclusion. It's about controlling the narrative.
That's a huge shift. You're not letting the reader discover it and ask questions. You're handing them the answer up front. You're owning the complexity.
Right. So for a concrete example, you could, restructure that whole section title. Instead of something generic like the surprise profit, you could call it Managing the Balance Sheet, $2.5 million in non-operating gains. That immediately sets the right expectation. The win here isn't operational. It's sophisticated financial management.
I like that. It reframes the whole segment around management skill with capital, which is a really powerful message right now.
It is. Or alternatively, if you want to stick with the net income figure as the headline, just follow it up immediately by reframing the reality.
How so?
You could say something like, while operationally still in a loss position with a reported loss of 3 cents per share, effective financial management through non-operating items yielded a positive net income of $2.5 million.
That phrasing works perfectly. It pivots from the operational loss to the financial achievement in the same breath.
And it frames that complex accounting detail as proof of management's confidence in their own liquidity and, financial hygiene. That's exactly what investors want to see.
Yeah. It prevents that moment where the reader has to go dig through the 10Q themselves and then feels like the writer was hiding the ball.
You got it. It builds trust. That alone elevates the entire report.
Okay, that's a perfect first point. Let's move to the main event, really. The Ask Sage acquisition. The material does a great job outlining the strategic fit, the huge growth potential, that 600% revenue increase projection, and the incredible reach.
Over 100,000 users. Yeah, the numbers are compelling, but I think there's a big missed opportunity when it comes to risk. The argument would be so much stronger if it moved the integration risk from a brief mention in the bear case to a proactively addressed part of the strategic fit.
So the weakness isn't that the risk is ignored, it's that it's just compartmentalized? It's too generic?
Yes. It mentions integration risks and cash burn, but it fails to connect that huge $456 million cash position directly to mitigating the specific risks of this deal.
Right, it just treats the cash as proof they can afford the price tag.
Affordability is just table stakes. The real hurdle is successful integration, especially in a sector this sensitive.
Okay, so what's the suggestion?
Introduce a focused section on risk mitigation. Use that liquidity argument to preemptively shoot down the most common M&A concerns in defense tech. Show that the cash isn't just for buying the company, it's for making the acquisition work.
And it has to be specific to that high-stakes government and defense environment.
Precisely. So for a concrete example, instead of just saying they can afford the $250 million deal, you need to specify how the remaining cash is earmarked.
Earmarked for what, specifically?
For potential integration overruns, for specialized security certifications. We're talking about the expensive, time-consuming clearances you need to onboard 100,000 users across the Space Force and the Defense Health Agency.
That frames the cash completely differently. It's not just a rainy day fund. It's dedicated integration capital.
It is, because integrating something like GPT-4 into highly classified environments isn't just about plugging things in. The regulatory hurdles are enormous.
And getting through those hurdles requires expensive, specialized, cleared teams.
Exactly. Teams that operate at a premium. If the analysis can show that BBAI has the cash to fund, say, a 2-year timeline for DoD clearances or a FedRAMP high authorization, well, the risk profile of this deal drops dramatically in the reader's mind.
That level of detail proves the writer understands the real challenges here. It's not just generic M&A risk anymore.
Right. You can even talk about how the cash gives them the capacity to build dedicated teams focused solely on those security and compliance bridges. It turns the cash from a passive asset into a powerful, proactive tool against integration failure.
Which is the #1 destroyer of value in these deals.
You got it. That moves the analysis from confirming the obvious to explaining deep strategic value.
A huge improvement. Okay, let's hit the final piece, which the writer correctly identifies as the core of the whole bullish case.
The business model shift.
The strategic shift from a consulting and services model to a scalable, recurring revenue SaaS model. They nail the why this matters.
They do. They nail the qualitative importance. But to maximize the impact of the business model shift, the material needs to structurally quantify the size of that recurring revenue stream against the old services one.
So the weakness is leaving the math up to the reader.
Exactly. It says the transition is huge, but it doesn't explicitly draw the line between the current service revenue. What was it, $33 million in Q3?
33.1 million, yeah.
Right. Between that and the projected $25 million in ARR from Ask Sage, the reader is left to figure out the real velocity of the change on their own.
And in a high-energy piece, you want to serve that conclusion up on a platter.
You do. So the suggestion is to build a clear analytical bridge. Use the numbers provided to show what percentage of the company's future revenue this new SaaS segment represents. Cement the significance of the change.
So how would you put that into action? Give me an example using those figures.
Okay, so let's use the hard numbers. You project the annualized Q3 service run rate. So 33.1 million times 4 is about $132 million.
Okay.
Then you directly contrast that with the $25 million Ask Sage ARR. The writer can then frame it by stating that this single acquisition instantly adds nearly 19% of the current revenue base.
But in high margin, scalable recurring revenue.
That's the key. That 19% figure, stated plainly, is incredibly powerful. It changes the entire story of the company overnight.
And why is that specific number, nearly a fifth of the business, so critical to Wall Street?
Because of the valuation multiples. Service revenue might get valued at, 1 to 3 times revenue, but high-growth, defense-focused SaaS, that can command multiples of 5, 10, even higher.
So by quantifying it, the argument shifts from they are pivoting to the pivot is so large right now that it justifies a complete re-rating of the stock.
It is the mathematical proof of the thesis. And if you want to keep it lighter, you could use a strong visual metaphor or even just a bullet point. Compare the slow, heavy nature of the $33 million services bucket to the speed and scalability of the new $25 million ARR component.
Right, emphasizing the velocity. Even though $25 million is less than $33 million, its future impact is disproportionately higher.
It's the new gravitational center for the company's valuation. By drawing that mathematical line, the writer proves why the stock reacted the way it did, why the analyst upgrades were fundamentally sound. It's a verifiable transformation.
That takes the analysis from just reporting facts to actual financial modeling. It's so much more persuasive.
I agree. It takes a very good report and makes it exceptional.
Okay, so let's recap the 3 main areas for improvement here. First, ensure full transparency on that positive net income. Integrate the non-operating source of the profit directly into the narrative to build credibility.
Second, proactively tackle the integration risks of the Ask Sage deal. Use that large cash position to detail specific mitigation strategies for those complex defense certifications, moving beyond just simple affordability.
And finally, to really hammer home the bullish thesis, explicitly quantify the SaaS transition. Show that new recurring revenue as a percentage of the old model to prove the magnitude of the transformation.
Those adjustments will make this already strong, high-energy report incredibly robust. It'll be that much more persuasive to an expert audience. The foundation is solid. This is just about making the structure bulletproof.
We look forward to seeing the revisions. If you implement these suggestions, we'd encourage you to submit your work back in for another look. That's all for this critique.